you get a question, even before you start reading through the question, find out what are you required to do. For instance, in this particular question, we are told required income statement for the year ended 31st of October 2016 and statement of financial position as the 31st of October 2016. So that as you now read your question, you're already getting the answers for your question. You're already getting the answers for your question. So we are told the following trial balance was extracted from the books of Jessica Pendo as the 31st of October 2016. We have the motor vehicle, we have equipment, we have furniture and fittings, inventory as at 1st of November 2015. When you're told 1st of November 2015, you're being given the opening inventory. Then you're given accounts receivable and accounts payable. Then accumulated depreciation as at 1st of November, that's at the beginning of the year, so that you can be able now to get the charge for the year, and then you add the charge for the year to what you had at the beginning of the year to get the total at the end of the year. Then you have capital, you have drawings, you have cash at bank. By the way, the question, if you just go online, you just download ATD past papers, you will get them between 2015 to 2024. You get all those past papers. So that's exactly what I have done. That's exactly what I've done. So return inwards and return outwards, cash at the bank, carriage inwards, carriage outwards, sundry expenses, office expenses, insurance, wages and salaries, rent, telephone expenses, motor vehicle expenses, purchases, and sales. Then you are given additional information. So we start with the workings. The adjustments that you make before you can get to answer the question. So we are told inventory as of that 1st of October 2016, you have been given the closing inventory there. A customer who owed Jessica 2.3 million shillings was declared bankrupt. So our debtors, we need to get our debtors account. If you get our debtors account and we say balance brought down from the trial balance, our balance brought down from the trial balance of debtors, accounts receivables, they are 114,300. 114,300. We are told that out of the 114,300, there was a debtor who we have not adjusted her account. The balance, the debtor who owed Jessica 2,300,000 was declared bankrupt. So we create bad debt account, bad debt expenses account, We remove from debtors 2,300,000. These are shillings in thousands. So we're saying bad debt account. In bad debt, we say debtors. We say debtors account 2,300. So we are removing from our debtors 2,300 because it's bad debt, and we are debiting bad debt expenses account. Then you are told an allowance of 2% is to be created. So out of the remaining debtors, 114,300, if you subtract 2,300, the balance 114,300 minus 2,300, you get the balance of 112,000. Our balance carried down is 112,000. Now we are told that out of the remaining debtors, 114,300, out of these remaining debtors of 112,000, we are providing for doubtful debts amounting to 2%. You must always know, before providing for doubtful debts, you must subtract bad debts. You get your debtors, subtract bad debts, and it is after you get the net debtors after deducting bad debts that you apply the rate for doubtful debts. So 2%. So provision for doubtful debts, it is 2% of 112,000. 2% of 112,000, 0.02 of 112,000, it gets 2 0.02 of 112, 123, we get a figure of 2,240,000. 2,240,000. Our provision for doubtful debts is 2,240,000, and that is what we will take to the when you get that, you always need to check whether we have provision for doubtful debts. The difference, you only take the income statement, the difference. I don't seem to be having provision for doubtful debts. I don't seem to be having provision for doubtful debts, and therefore I will take it as an expense. I will take it as an expense, and also I will also take it as an expense. So this will be the first provision will be an expense, and the bad debt will also be an expense. Then we are told the depreciation rates are given. The depreciation rates are given. The depreciation rates are given. So we're saying depreciation expenses, and we have motor vehicle, equipment, furniture, and fittings. Motor vehicle, equipment, furniture and fittings. And the rate is 25, 20, 10. 25%, 20%, and 10%. Those are the expenses. So we apply that on the original purchase cost, because we are told that they are depreciated on a straight line basis. The same amount. So motor vehicle, it is 16,950. So times 16,950. Equipment, it is 20,010. And furniture and fittings is 2,400. You are able to get the figures there. And we're saying it is 2.25 of 16,950. You get 43, that's 7.5. 42, that is 7. 47.5. 20%, 0.2 of 20,010. 0.2 of 20,010 is 4,002. 4,002. And this is 240. It's 240. 240.2 of 20,010. Of 20,010. You get 4,002. So that is the depreciation expenses. These are the expenses that we take to the income statement, and this in the income statement we take these expenses, but in the balance sheet we get the opening depreciation. We add this to get the depreciation charge at the end of the year to deduct from the original purchase cost of the asset. We are told insurance prepaid was 576,000. So our insurance, if we go back to trial balance and we look for insurance, our insurance account, from the trial balance, if you go from the bottom 1, 2, 3, 4, 5, 6, 1, 2, 3, 4, 5, 6, 29.76. The balance from the insurance, balance brought down is 29.76. It is 29.76. The balance from the insurance account, it is 29.76. And then we are told, out of that, 576 is prepaid. 576 is not balance carried down. 576 is not an expense. We are carrying, it will become an expense next year. 29.76. It is not an expense this year. It was paid, but you have not used it. It was paid, so we cannot take it to the income statement as an expense. So we just do it that way. We get the balance brought down, then we carry down what is not spent. What is spent, we take to P&L account. What is spent, we take to P&L account. And all you need to do is 29.76 2976 minus 576 minus 576, we get 2400. So out of the 2976 which we paid for insurance, we are saying we never spent 576, so this will be carried down as an asset, a current asset in the balance sheet, but the 2,400, because it was spent, it becomes an expense in the income statement. Then you are told wages and salaries accruing amounted to 3 million. So wages and salaries accruing. The employees provided services. The employees provided services, but we have not paid them as at the end of the year. So if we were to look at the wages and salaries, 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. 117,000. 117,000. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Yes, 117,000. And we were told we had not paid wages amounting to 3 million. We've not paid wages amounting to 3 million. So we add 3 million here. And it becomes 120 millions. But now we are creating a liability called wages payable. We are creating a liability called wages payable amounting to 3 million. And we are saying its balance. The corresponding account is wages and salaries account, 3 million. So this becomes a current liability. In the balance sheet. So that's the way to do the adjustments. And once you have done your adjustments, you just go to prepare the income statement and the balance sheet based on our format. Remember our format. You must always remember the format of the balance sheet and you memorize it. So that when you call to prepare the balance sheet, the income statement, it becomes very, very, very easy. So let's try to prepare the income statement. So the income statement, we say, I think I can delete everything. I don't know. Well, because of the space. So let's try to do the income statement. We say, we prepare the income statement. Jessica Pendo, income statement for the year ended 31st of October 2016. Jessica Pendo, income statement for the year ended 31st of October 2016. So we start with our sales. If you look at our sales, you see 76 million. Our sales is 143. Where is our sales? I'm looking for our sales. Our sales were 1,174,000. Everything is shillings in thousands. 1,174,200. Our sales are 1,174,200. Then we say less, that is sales. We say less return inwards. The sales, the goods that were returned. Less return inwards. And we say the return inwards is 6,330. 6,330. So if we were to do that question, if we were to do it that way, we would be saying 1174,200 minus 6,330. We get 1167 We get 1167,870. 1167,870. That is our net sales. 1167,870 gives us net sales. Then we say less cost of goods sold. Less cost of goods sold. Less cost of goods sold. Cost of goods sold. And our cost of goods sold, we start with opening stock. You start with opening stock. And the opening stock as given in the question 1, 2, 3, 4. 1, 2, 3, 4 is 217, 230. 217, 230. Our opening stock from the trial balance is 217, 230. 1, 2, 3, 4. 1, 2, 3, 4. Then we add purchases. We add purchases. We add purchases. We add purchases. And our purchases there at the bottom is 764, 430. Our purchases is 764, 430. 764, 430. 764, 430. So if we were to say 217, 230, 217, 230 plus 764, 764, 430, 430, we get 981, 660. 981, 660. 981, 660. Then we add carriage inwards. We add carriage inwards. Add carriage inwards. Add carriage inwards. Add carriage inwards. Our carriage inwards is a figure of 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. 2280. 2280. 2280. 2280. Carriage inwards. Carriage inwards is 2280. Carriage inwards 1, 2, 3, 4, 5. 1, 2, 2280. So you add, you get 14. 8 plus 6 is 14. 7, 8, 9. 3, 8, 9. Then we have return outwards. So this less return outwards. Less return outwards. The inventory which we had received and we returned. We never used it. We returned. So 1, 2, 3, 4. 1, 2, 3, 4, 60. Yes, 37, 20. 37, 20. We subtract 37, 20. We subtract 37, 20. 981, 940 minus 2280. 2280. We get 979, 380. I don't know. 981, 660. 981, 660. 660. If you add 2280, we get 983, 940. 983, 940. We subtract 3720. 3720 return outwards. We get 980, 220. 980, 220. You get 980, 220. And these are the cost of goods available for sale. Cost of goods available for sale. Cost of goods available for sale. The space is small, but cost of goods available for sale. Then we less closing stock. We less closing stock. We less closing stock. And the closing stock from additional information number 1, it was 268, 212. 268, 268, 212. 268, 212. I hope you are following. I hope you're following. 980, 220. We less 268, 212. 268, 212. We get a figure of 712, 008. So 712, 008. That is the cost of goods sold. 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 That's the cost of goods sold. It is 712,008. 712,008. Now, the sales, remember what we have said? We said sales, net sales, less the cost of goods sold. So you subtract how do you arrive at the cost of goods sold? You get the stock that you had at the beginning of the year, you add purchases, you add carriage inwards, you subtract return outwards, you get the cost of goods available for sale. The goods which we had bought, or the goods we had at the beginning of the period, and the ones we bought, they were worth 980,220. But we never sold everything. And because we want to get the cost of goods sold, we subtract the closing stock. We subtract the closing stock to get the cost of the goods we sold, and we are saying it is 712,008. Now, then we get sales, our net sales, we subtract the cost of goods sold minus 1167,870. 1167,870. We get 595. We get 595,228. We get 595,228. Thank you. So once you get the cost of goods sold, 712,008, you subtract net sales, you get the gross profit. You get the gross profit. You get the gross profit. Our gross profit is 455,862. Our gross profit is 455,862. And then we ask ourselves, do we have other incomes? This question does not have other incomes. But there are some questions that you find has other incomes. So if you always remember your format in your head, you must remember your format in your head. So you should have actually have said add other incomes. But now because we don't have other incomes, we say less expenses. We say less expenses, less expenses, less expenses. And I like saying always, first deduct the expenses which you did at adjustments. First of all, always deduct the expenses that you did the adjustments. So that after you're through with the expenses which you did adjustments, now you go to the trial balance and you look at the expenses which never required adjustments. So if we just come here, we will say bad debt was 2,300. Bad debt was 2,300. We will say provision for doubtful debts, 2,240. Provision for doubtful debts. Provision for doubtful debts. Provision for doubtful debts, it is 2,240. 2,240. Please note how you deal with provision for doubtful debts. Good students know the examiner's traps. Now, if you get provision that the company is providing or the firm is providing for provision the first time, the whole provision is taken to the income statement as an expense and we deduct the debtors to get the net debtors. But if from the trial balance we have a provision, it means the provision at the opening, at the trial balance is the opening provision, and the provision that you are now calculating is the closing provision. The difference between the opening and the closing provision, that's what you take to the income statement. That's what you take to the income statement. An increase becomes an income. A decrease becomes an expense. An increase becomes an expense. A decrease becomes an income. Then we check for the others. Depreciation. We get motor vehicle, 43, that is 4237, motor vehicle, 4237.5, 4237.5, equipment, 4002, 4002. Furniture and fittings, 240. Then our insurance expense, 2,400. It is not 2976. Whatever you're taking to the income statement is 2,400. Insurance, 2,400. Then we get wages and salaries, 120,000. Wages and salaries, 120,000. 120,000. Those are the expenses which required adjustments. Those are the expenses which required adjustments. Now, we go to expenses which didn't require adjustment. The way we extracted them in the trial balance, they were never requiring any adjustments, and therefore we get the ones which do not require any adjustments. So because of the challenge of space, we bring it here. We bring it here. We bring it here. We bring it here. So we go through the trial balance to find expenses which do not require any adjustments. Drawing cash and hand, returning was return. Carriage outwards being the first one. Carriage outwards being the first one. Carriage outwards. We have carriage outwards. 550. 8550. Carriage outwards amounting to 8550. 1, 2, 3. 1, 2, 3. Yeah, 8550. Then we have sundry expenses. Sundry expenses. 648. 648. 648. Sundry expenses 648. Then office expenses. Office expenses 2235. 2235. Insurance we have captured. Salaries and wages we captured. Rent 1, 2, 3, 4. 1, 2, 3, 4. 1, 2, 3, 4. 1, 2, 3, 4. Rent is 24,600. 24,600. 24,600. 24,600. 1, 2, 3, 4. 24,600. Then telephone expenses. Telephone expenses 2040. 2040. 2040. Telephone expenses 2040. Motor vehicle expenses. Please note, these are motor vehicle expenses. It is not motor vehicle. It is not motor vehicle. These are the expenses that we incurred through the motor vehicle. 4470. 4470. 4470. 4470. So those are the expenses. Those are the expenses. So we add up the expenses. We add up our expenses. 2300 plus, from here now, from here we go down, plus 2240 plus 4237.5 plus 4002 plus 240 plus 2400 plus 123 plus 8550 plus 648 plus 2235 plus 24,600 plus 2040 plus 4470 plus 4470. Habari. Mpaka hapo? So, okay. Can we continue?
Yeah.
Yes, you get 177, 962. 962.5. Those are the total expenses. These are total expenses. Those are total expenses. Now, you get your total expenses, you subtract from the gross profit to get the profit for the year. You subtract 455, 862, 862, you get 277, 899, 899.5. This is the balance sheet, the statement of financial position. We say that the balance sheet is the statement of financial position. So I want us to prepare the balance sheet now so that we can finish our question. We can finish our question by preparing the balance sheet. By preparing the balance sheet. I don't want to delete the depreciation because we will need them as we do the balance sheet. We will need them as we do the balance sheet. We need them as we do the balance sheet. So we will go to Jessica Pendo. Please see the way we write the title. See the way we write the title. We call it Jessica Pendo. Jessica Pendo. Jessica Pendo. Statement of financial position. Statement of financial position. That's what we call, that's the balance sheet. Statement of financial position, asset. Please note that in the income statement it says for the year ended, but in the balance sheet we say as at 30th of October 2016. 30th of October 2016. Please look at the format. The name of the firm, the nature of the financial statement, and the date. Then you come here and you say assets. Then you say non-current assets. Non-current assets. Non-current assets. And we say we get the cost, we get the net book value, we get the provision for depreciation. That is the accumulated depreciation. Then we get the net book value. 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 Very, very important. Remember, our assets are arranged in order of permanence. Our assets are arranged in order of permanence. If you want to be good in accounting, you must memorize the format for the balance sheet. You must memorize the format for the balance sheet. Land and building, plant and machinery, furniture, fixtures, fittings, motor vehicle. Then current assets, inventory, trade payables, other payables, prepayments, investments, bank, cash. That order is very, very fundamental. You must record them in that order. So our oldest here is the equipment. In order of permanence, the most permanent here is the equipment. So we get our equipment. We get our equipment. From equipment, we get to furniture and fittings. Furniture and fittings. Furniture and fittings. Then we go to motor vehicle. That order is very, very important. It is in order of permanence. Motor vehicle 16950. 16950. Equipment 20010. Motor vehicle 16950. 16950. Equipment 20010. Equipment 20010. Equipment 20010. Furniture 2400. Furniture 24. Furniture and fittings 2400. Now, please mark this, that you get the depreciation as per the trial balance. The trial balance, you are given the depreciation at the beginning of the year. The depreciation for motor vehicle at the beginning of the year was that in 390. At the beginning of the year was that 390. But what we have now depreciated this year, motor vehicle, is 4237. So we add 4237.5 to get 7627. 7627.5. 7627.5. I want to repeat again. To get the depreciation charge at the end of the year, you get the depreciation at the beginning of the year. You get the depreciation at the beginning of the year. For the motor vehicle was that 390. That 390. Then you add the charge for the year, which is 4237.5 plus 4237.5. You get a figure of 7627.5. The depreciation at the beginning of the year is the depreciation from the date we purchased the item all the way to the beginning of the year. Then you add the charge for the year to get the depreciation from the date we purchased up to the date of the preparation of the balance sheet. Now, we go to the next one, which is equipment. At the beginning of the year, it was 4,002. 4,002. So we add what was charged this year, another 4,002, another 4,002. So we get 8,004. 8,004 for the equipment. For the equipment, 8,004. For furniture, at the beginning of the year, it was 240. For furniture, at the beginning of the year was 240. 240. If we add the charge for the year, it is under 240, it is 480. 480. Now, once you get the original purchase cost of the asset minus the accumulated depreciation, you get the net book value of the asset. Get the net book value of the asset. So 010 minus 8,004, you get 12,006. You get 12,006. The same thing we do there. 2,400 minus 480, you get 1920. You get 1920. The other one is 16,950. 16,950 minus 7627.5 minus 7627. Sorry. 16,950 minus 7627.5, we get 9322. 9322.5. 9322.5. Now, this is the net book value. This is the actual value of our assets. Although we bought them at this level, we'll have lost this value. This is the actual value of our assets. So if we add all the actual value of our assets, plus 1920, plus 12,006, we get 23,248.5. 23,248.5. 23,248.5. 23,248.5. That is what we call the total non-current assets. The total non-current assets. They are assets that are in the firm for longer than 1 year. They are in the firm for longer than 1 year. Then we come to current assets. Remember, the format is always in the head. The format of the current asset is always in the head. The format is the head. Inventory, trade receivables, other receivables, prepayments, investments, bank, and cash. Now from the head, you go checking what do we have. So our inventory is given. Our inventory is given as the last item there. And we say it is 268,212. It is 268,212. It is 268,212. We say trade receivables, our trade receivables, we say, remember what we did, our trade receivables. We got our trade debtors, we got our accounts receivables, which was 114,300. It was 114,300. 114,300, we subtracted 2,300, the bad debt, we subtracted 2,300, and we were left with 112. We were left with 112,000. We were left with 112,000, and we said, so we were left with 112,000. We were left with 112,000, but we say that we are providing for doubtful debts 2%. So 0.02 of 112,123, you get 2240. So we say less provision for doubtful debts. Less provision for doubtful debts. Less provision for doubtful what?
Debts.
2240. 2240. 2240. So we subtract that and we say 112,000 minus 2240. We get a figure of 109,760. 109,760. 109,760. 109,760, that is our net debtors. Our net debtors. Our net debtors. Then we look for the prepayments. We said from our additional information, we said insurance was prepaid by 576. So we add prepaid insurance. Prepaid insurance 576. Prepaid insurance was 576. Prepaid insurance was 576. Then we look for bank and cash. We look for bank and cash. 1, 2, 3. Bank is 13,216. Bank is 13,260, and cash. Bank is 13,260, and cash is 336. 336. And those are the total current assets. Those are the total current assets. Those are the total current assets. If you add them up, you will get 268,212, 268,212 plus 109,760 plus 576 plus 13,260 plus 336. We get a figure of 392,144. We get a figure of 392,144. Those are the total current assets. Those are the total what?
Current assets.
Total current assets. Those are total current assets. Those are total current assets. So if you add them now, if you add the non-current assets with the total current assets, you get plus 23 to 48, 23 to 48.5, 23 to 48.5, you get 415,392, 415,392.5. You get total assets. You get total assets. You get what?
Total assets.
You get total assets 415,392. You get total assets 415,392. Then you ask yourself, how is the funding? How was it funded? How were the total assets funded? How are the total assets funded? So we say financed by. Financed by. We say financed by. So below there you just say financed by capital and what? And liability. Capital and?
Liability.
Capital and liabilities. Capital and liabilities. Capital and liabilities. Assets are always funded by either capital or liability in a sole proprietorship. In a sole proprietorship. By capital and liabilities in a sole. From the trial balance is given as 143,393. 143,393. Our capital from the trial balance is given as 143,393. So we add profit for the year. We add profit for the year. We go to the income statement up there, which you have already erased. We add the profit for the year, which we have said is 899.5. 277,899.5. From our income statement, that was our profit for the year. That was our profit for the year. So if you add them now, 143,393 plus the profit for the year 277,899.5, we get 421,292, 421,292.5. Then we less drawings. We less what?
Drawings.
We less drawings. From the trial balance, you can get our drawings is 85,800. 85,800. If you subtract drawings, 85,800 minus 85,800, you will get a figure of 335,492.5. 335,492.5. 335,492.5. 335,492.5. 335,492.5. Those are capital at the end of the year. Capital as at 31st of October, 30th of October 016. That's the closing capital. This is the capital at the beginning of the year. This is the capital at the end of the year. Then we look for non-current as, remember the format. Remember the format in the head. Remember, we say then, from there we say, so you underline this, we always say non-current liabilities. But the question does not have current liability, non-current liabilities, so we now capture current liabilities. We capture current liabilities. Remember the format in the head. Remember the format in the head. The format in the head for current liability is always bank overdraft, trade payables, other creditors. Other creditors. Now in our case, we do not have bank overdraft, so we go for trade payables. We go for trade payables. You go for what?
Trade payables.
For trade payables, you got, we said accounts receivables and accounts payables. So our accounts payable from the trial balance is 76,900. Accounts payable is 76,900. 76,900. Now you add other payables. And the only one we have is wages. If you look at our additional information, number 6, we said accrued wages were amounting to 3 million. So wages payable, we said number 6, it amounts to 3 million. We don't have another current liability, so we get 907. These are the total current liabilities. Total current liabilities. Now, we get the total current liabilities and we add capital and liability to get the total capital and liabilities. So if we said 79,900 plus 335,492.5, we get 415,392. We get 415,392.5. 415,392. We say total capital and what? And liabilities. Total capital and liabilities. Total capital and liabilities. Now you realize that 415,392 capital and liability is the same as 415,392 current assets and non-current what? Assets. So the balance sheet should always balance. The assets must always be equal to the sources of funds. The assets must always be equal to the sources of funds. Once again, ladies and gentlemen, we have been doing this for the last 16 years. Please join us and train with the best. Get our contacts and contact us for our massive January 2025 intake. Thank you very much. Merry Christmas and Happy New Year.